It is a market that saw a bounce, but it was 5 days of losses before that. Is this a good sign ahead of PPI?
It was 5 days of losses, although, again, I'll look at the semiconductors, which are down 1% only from that almost 30+% move off of that CPI October 13 intraday low. And I refer to that going into tomorrow's PPI because we really do have a lot of relief across goods, maybe not services, and the entire commodity complex. Lumber prices are below where they were before COVID. You have cotton prices, which are up about 10%. You've got wheat prices, which are pretty much in line with where we were before we went into Ukraine. And so the dynamics around some of the feed inputs into inflation, really, I think, on the PPI side are better. I actually think that tomorrow's PPI number can be another catalyst for markets here. I think we've had a day to digest the dynamics. We've had a few days to digest a very significant market move. But it's not me saying it's full scale into year end, but it is telling me that I do think we have a place where markets can get some relief out of this. Inflation is much better.
So, Courtney, if you look at the way things have set up, and you mentioned Tim does the semiconductor trade, it's been pretty range bound, let's be honest, and it has been a downside move over the course of the last year. Are there places, though, that you're seeing some of those tea leaves, canaries in coal mines, so to speak, about whether or not there could be this continuation? I mean, this is a seasonably strong time of the market. Why isn't it going higher, markedly so?
Well, we already did have such a run up, right? So, yes, the markets have been down the last 5 days, but right before that, I mean, we have had such a run since about mid-October. So I think it's normal to see somewhat of a pullback, but it really has been so dependent on inflation this year. And I think it's going to continue to be dependent on inflation. I do agree. I think PPI will likely come in light here. We're seeing lumber prices are below what they were in 2020. Gas prices are now below what they were last year. I mean, things are coming down pretty significantly, and that's really going to lead into the markets here. And I do think you want to make sure you have your best foot forward. We're also looking at a time that bearishness is still really low right now, which does, I think, lead to over pessimism in the markets. And I think, if anything, leads to a better year-end rally potential here than anything else.
Guy.
Yes, sir.
If we look at the way things are shaping up, I mean, there are people who are altering their holiday shopping plans. So says the CNBC All-America survey. People are spending less. Inflation's a problem. The consumer, though, is still relatively healthy. It's confusing. But this is a time when the American consumer is front and center. Is it enough, though, positivity-wise, to get us out of this funk that we're in for the markets?
Market holds here. I mean, to me, it's always been an overlay of the S&P 500 is an overlay of consumer sentiment, whether that's justified or not. People feel okay as long as the market's not breaking down. And obviously, to Courtney's point, recently the market has rallied. But to state that the health of the consumer is somehow robust, I would push back and say, hey, consumer debt in this country is now north of $5 trillion. That's a number we've never seen before. 20% of that now credit card debt north of $1 trillion, which is no good. Now, the U.S. consumer will always spend. I never question their want to spend. Should they be spending? That's the question. And if the market were to take another leg lower on potentially a hotter than expected PPI, which I think nobody's really expecting, then I think people say, wait a second, into Christmas, maybe things aren't as good as I thought.
Yeah, as it relates to the rally, though, like, just think about what's happened here. We've seen a big rotation, right? So we saw a rotation. Like, look at how much the S&P outperformed the NASDAQ since mid-October, and it's pretty substantial. And you think about this, Mike Wilson at Morgan Stanley had a comment today about he thinks value stocks. Now, he had this tactical rally from mid-October. He thought we'd see a 15% rally. We got that. Now he's saying that he thinks value is actually a pocket of risk. And what is that? That's energies, that's financials, that's industrials. And so we've seen a crowding in that. And if you think that we're going to have some sort of recessionary environment, and maybe that's exactly what some of these numbers, some of these inflationary numbers, some of these readings about industrial commodities and the like are saying to us, then you got to be careful here because the rotations have been fairly aggressive. It's one of the reasons we have these bear market rallies over the course of this year, some between 15 and nearly 20%. And so to me, I think the higher we go into the end of the year, I don't think we're going to go much higher, to be very honest with you, is the lower we go early in January and February.